Welcome to our weekly market review. As usual, I'm joined by Director George Glynos. George, festivities, they're in the air. We can feel the vibe. Everyone has that extra spring in their last step for 2025. Apart from Moody's, they ain't feeling the positive South African vibe just yet. On Friday, they did not shift South Africa to a positive outlook like a lot of us kind of anticipated they will do. Are they being realistic or overly pessimistic?
Yeah, just being a Grinch. I mean, it's quite peculiar for me to see a ratings agency not really mentioning some of the fairly sizable developments that we've had through the course of this year, from getting removed off the grey list to the inflation target dropping to bond yields declining the better part of 200 basis points depending on where you look on the curve, to a medium-term budget that was well received, to pushes for Operation Vulindlela and greater privatization, to anticipation of better growth environments going forward, liberalizing some of the network industries. There's a lot going on, and yet what I found a little bit peculiar is that they gave um, it almost felt like they gave a better outlook when South Africa was doing nothing, and now when South Africa is doing quite a lot and arguably should be rewarded, they stand still and do nothing. So we've gone from a position where S&P was playing catch up to Moody's to now S&P giving a positive outlook and Moody's still sitting on neutral. So I think it's a little bit peculiar. The market is quite clearly not agreeing with Moody's. They're seeing more in the pipeline than clearly Moody's are seeing. So I think at this point in time, I'd probably believe the markets more than I would Moody's. But that's the reality of the situation at the moment, is that Moody's left things on hold. I think they may be risking being a little bit behind the curve because there have been some fairly substantial changes recently, and I think that they would have been better placed just at least paying lip service to some of those changes, offering some perspective as to why it might be that South Africa could be in line for some improvements in their credit ratings going forward if they continue down the reformist path that they appear to be on. So yeah, it was a little bit of a strange one for me. I think it's, dare I say, a little bit wide of the mark. If you are a ratings agency and you're looking to give forward guidance on whether or not an investor's funds are going to be safe for the foreseeable future, surely you need to pay attention to some of these positive developments that have unfolded, and take that into consideration. So I was a little bit surprised. I don't think it bothers the markets much though at all. If I have a look at the way that Rand's trading comfortably below 17, bond yields have consolidated their recent gains. So markets clearly seeing things a little more optimistically than Moody's is at this stage.
At least another one of the positive steps that we have taken from the South African Reserve Bank side is that we are now moving from JIBAR to ZARONIA. And the SARB has been prepping markets for quite some time for this change to come. But George, why is this necessary? Why is this move needed?
Yeah, I think it's more to align ourselves with what they call international best practice, in the sense that they're not letting the banks set a rate which was somewhat forward-looking or predictive, where they could influence the rate to some degree. They're taking it on actual traded prices. So there's an algorithm that weights the contributions from the different banks, but they're specifically working on traded prices. So the benchmark rate that you see is going to be a slightly backward looking, but more coincident, shall we say, a coincident indicator that will fluctuate day by day. And so I think that's probably a good way to go. They do need to make a slight adjustment for the spread between JIBAR and ZARONIA, which is approximately 16 basis points. So they're going to add that onto the ZARONIA rate, which is roughly 16 basis points below what it is for JIBAR at the moment, and that's just to smooth the process into the new benchmark. And that kicks in from the beginning of Jan. So we're shifting to a new regime. I think it's technically probably more more in line with international best practice than what we've had up until now. And I don't think it's anything to be afraid of. I think it's just the modernization of South Africa's monetary policy and a move in the right direction. So it's more automated. Let's just think of it in those sort of terms.
Obviously, the big event this week is the Fed's final meeting. I think a 25 basis point cut is all but priced in at this point in time. So assuming that it's so priced in, market reaction is likely to be muted.
Yeah, I mean, when I look at the Fed funds futures, they're talking about it in those terms. So I think that would be largely priced in, as you quite rightly point out. Again, I think what's even more interesting than the decision for me is going to be the kind of guidance given on the outlook. And what's interesting there, I think specifically for me, is this dynamic that's unfolded between the central bank and the bond market. The central bank's been reducing interest rates, and bond yields just are not listening. So if you have a look at the 10-year bond yields this morning, it's still sitting at 4.14% on the 10-year benchmark, and they're struggling to get that bond yield down. And we can have some debates around why those bond yields aren't coming down, but in the main, I think it's very much a function of concern related to whether or not this government is going to have the ability to rein in their debt. So you run ultra loose fiscal policy, and you don't have the ability, or you don't show the ability, or the market doesn't have confidence in the government's ability to rein in that debt. It needs to be priced for. And at the moment, we're seeing that not just in America, we're seeing it in the UK and Europe to some degree as well. So there are concerns about the fiscal outlooks. Basically, these governments have been borrowing too much money. There's some that are arguing that these bond yields rising also show that there's confidence that these economies are going to improve, that their growth rates are going to improve, and that that'll keep inflation a little more buoyant for longer, which at the margin is possible with interest rates being cut and some reforms coming through. But for the most part, I still think it's more fiscal picture than it is a positive growth outlook that they are turning their attention to.
Yeah, these economies continue to come under stress. This will be our last market review for 2026, but there's so much going on. While we're winding down, it feels like the geopolitical tensions, the equity markets, everyone feels like it's ramping up. So it's going to set the scene for a very interesting 2026. And of course, we will be there to keep everyone updated. George, have a good festive season. Thank you very much. And we will chat again in 2026.
Thanks, Ilze-Marie, and to all our listeners. May they have a blessed festive season. And yes, we look forward to more interactions in the new year. Thank you very much.